We'll play you more of that very interesting conversation. But for the moment, let's concentrate on somebody who is a newsmaker. On Friday, Federal Bank announced that it has picked up a 26% stake, or will pick up a 26% stake in Acquirers Capital in a bid to help them broaden their product offering to corporate and SME clients. Shyam Srinivasan, Managing Director and CEO of Federal Bank, is with us. Good morning, Shyam. If you can just take us through, how much you're paying for this and what immediately will you gain from this?
Firstly, like you mentioned, we have only announced the intent. We have to get the regulatory clearances, which the process is well underway. As you know, the bank has been growing quite consistently, and our credit market share has been increasing regularly. So we felt that the commensurate business revenue market share growth has to be aided. So in that journey, we started looking out for a partner who can bring in domain expertise. Our origination capabilities have become better. So we looked out for a partner, and in Equirus we found a credible partner who has the domain expertise combined with our sort of origination capabilities. We think we should be able to go out and present I would say, a universal solution to our target client. So that's really the focus. What we have paid for is not so significant. I think it's a fairly capital light business. So it's really how we leverage it over time will play out. It's really, we're paying for 26% of a fairly probably in the low 2 digits.
So largely debt capital. Is it largely debt capital, Shyam, that you are going to look for help from acquirers?
They are a full service firm, right? So we really are looking at what we should be presenting to client on a range of things. So we are not restricting it to, they have I think 5 to 6 verticals from the high-end corporate to the high-end consumer. And considering we have a large NR base and we haven't really exploited the potential of those customers just beyond the normal vanilla deposit products, the offerings can be quite compelling both for corporate and consumer. So we're not restricting into any one space.
So in terms of...
They have 5 to 6 verticals which are all I would say growing quite well.
Sure. So in terms of growth, how will this increase both your corporate and your SME client portfolio?
So I think growth on these segments has been north of 20-25% for the last 2 years. The segment corporate or SME. Where we believe we haven't gained substantially is the beyond just the normal consumption of credit. How do we ensure we bank the customer, whether it's for they're raising capital, both debt and equity, as also some other structures. And with our Gift City presence, with the Equirus partnership and our origination capabilities, and with more focus on treasury related products, we think we'll be a universal financial services provider. So this is how the model is emerging.
Okay. Just a word on the traditional business itself. How have the first 2 months of the fourth quarter been, both in terms of loan growth and in terms of asset quality?
See, I think for us, credit growth has been quite consistent, and even this quarter it's not out of pattern. We see the momentum is reasonably strong. Like I keep maintaining, our origination capabilities and our presence in many geographies has helped, and that will continue. Our appetite remains good. Our credit quality, nothing that is out of the ordinary. We seem to be in the same kind of run rates that we've sort of focused on. The impact of the recent stressed asset resolution, we have to see. That's unclear to any of us. I think through March we'll be able to get a better picture, but the organic slippage are well under control.
But it will definitely be higher, no? Because others will have to recognize a lot of their SDR, S4A as NPA. So as a consequence, even you will have to recognize? I mean, have you identified how much of your asset book is exposed to these partly restructured assets?
Yeah, the good news, Lata, the intersection between our portfolio of SDR, S4A, 525 and the market is relatively limited. So if the Q4 dimension may not be material, between Q4 and Q1 of next year is what we have to see.
Okay.
But I'm quite hopeful that we've probably seen the worst part of everything. But I'd really keep my vigil for the next 20-30 days to see how other banks are all shaping up on this. And if there is any, I think there's some regulatory clarifications that are being sought.
So in terms of slippages, you were saying that, slippages will move southwards. Last quarter, there was a large loan that you had, that slipped, the loan that you gave to the Kerala government. Any such cases in this quarter, or can we expect the slippages to revert back to the average that you saw in the past couple of quarters, say, of about 200-300 crores?
Okay, I didn't say it's going to go southward, I said in the same zone. But having said that, last quarter was not a loan to the Kerala government, it was the education loans given to individuals which had a dispensation given by the Kerala government, and that resulted in about 70 odd crores of slippages in the last quarter. That certainly won't repeat itself. So to that extent, the number of which was about 300 or close to 400, 370 if I recall right, will trend down considerably this quarter and be somewhere in the 250 to 300. I'm caveating that. Only thing is to understand the implication of what the recent regulation of February 12th are going to play out. But we'll know that in a week or two, or maybe 3.
Okay. Well, thank you very, very much, Shyam, for joining us with your thoughts on, this deal itself and, of course, what can happen because of the NPA resolution rules. That remains a kind of a unknown. There could be a goodish number of loans that banks will have to recognize as NPA, and actually that's why the PSU banks are under so much pressure, and there will be a penumbra effect of loans.
Yeah, but having said that, the Bank Nifty actually from the low point has recovered and now has crossed the high point of the morning.